This week, Adobe is going to report Thursday after the close. This is a $250 billion market cap company. All right, think about that. So on Friday, NVIDIA moved the size of Adobe. The stock is basically not really outperformed by any means the S&P or the NASDAQ. It's down about 12-13% from its recent all-time highs. You could say this is like a great name to play in the space. Not that expensive relative to that growth and the like here, but I guess my only point is that 2 consecutive quarters, this stock has sold off based on what they've told you about the prior quarter and the quarter that they're in, that they've guided to. And I just don't think in this environment, they're going to be able to put up a beat and raise that justifies maybe the valuation. To me, this is the name that I want to focus on this week because a disappointment here might take I guess the bloom off the rose of some of these other software names that have been hanging around the rim here.
On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the Monday edition of the On the Tape podcast. I am Dan Nathan. I'm joined by Guy Adami and Liz Young. That would be EY from SoFi. Welcome this morning, people.
Yo.
Buenos dias.
All right, we have one job here this morning. That's to get you ready for this trading week. There's a lot going on this week. We have CPI, the all-important CPI. That's not Guy's favorite measure of inflation, but I think that he is probably going to be in the pesky and persistent camp. I don't know. We'll see. We'll find out.
Stop. Before you even tease the rest of this stuff, you do notice, by the way, that everybody seems to have come to that line of thinking.
Yeah,
I mean, and we were talking about that a year and a half ago. We were mentioning the 2 PEs, pesky and persistent.
Yes.
Is that correct?
But as your football coaches used to tell you, Guy, early is what?
Early is on time.
Yeah.
On time is late.
Yeah.
And late, don't even bother knocking on the door because it'll be closed and locked.
Don't even bother. But you have been all over that. And that was actually a really interesting point to be reminded of the potential for the deceleration in inflation to basically stop at some point. And then you've been also talking about, as Liz has been, the cumulative nature of those inflation prints over the period of time. And that is what's leading, I think, many to kind of like basically say, hey, listen, that inflation dragon is not slayed. But to your point, Guy, about teasing, we do have a little housekeeping here. We want to remind everybody that Guy and I followed with Liz on Wednesdays. We do the market call on the Risk Reversal Media YouTube page. That goes live at 1 p.m. Monday through Thursday. Guy and I have a very important announcement today about a new sponsor and a new product that we're going to be talking about every week. So tune in at 1 p.m. Monday through Thursday for that. Okay, Liz, what are we doing here? CPI, is it the all-important? We were all focused on the jobs number last week. Before that, it was like something else. You know what I mean? It's always something going on here. Give us the 411 on the CPI, how you're thinking about it, hot, cold, how the markets react, what yields do, and the like.
Well, just so everybody's on the same page, I'm looking at the numbers right now. The survey expects tomorrow's CPI report, the headline number, that means includes everything, to come in at 3.1% year over year, which is no movement from the last time. We would call that, what do we call that, Guy? Persistent, I think.
That would be both pesky and persistent.
And then we've got a CPI ex food and energy. So that's core CPI, not the super core measure, but the core CPI. That one is expected to come in at 3.7% year over year, down from 3.9% last month. Also, a reminder, the Fed's target is 2%, but that's PCE, so that's a different measure. But here we are, stuck in this range of still above 3, still above 3.5 in the core measure, which is the one that supposedly is measuring more underlying inflation. And here's the other thing I will remind everybody of. If we think back to when we had the goods inflation, right, that was all over the place. We had food inflation that was astronomical. We had used car inflation that was astronomical. And we were playing this game of whack-a-mole. There was a new problem that popped up every few months. And then the goods inflation went away. But while we were talking about goods inflation, occasionally we'd mention services inflation and the fact that services inflation wasn't a problem yet. And that's good because services inflation is stickier than goods inflation. Okay, so now fast forward, 6 months to a year, and here we are. Goods inflation has all but left the picture. Services inflation is what's left, which is what the Fed was trying to get at when they started talking about the super core measure. And we are stuck with services inflation that is, in fact, sticky, which is what would be called pesky, I think.
And persistent.
So that's the pesky. Okay. Well, maybe
Elizabeth
I'm
is
not
spot
using your
on.
words
No,
right,
no,
but
no. You're
that's the
looking.
truth.
That's exactly right. And if you think about it, the reason why we came to the pesky and persistent, because I said, there's another PE when people said that inflation had peaked. That also starts with PE, and that's exactly right. And I'm glad Elizabeth mentioned this because, quite frankly, you're one of the people that said, "Beware of services inflation. It's coming to a theater near you," and here we are. And that's going to be tough getting. Goods is one thing, services is entirely differently. And once it reaches these plateaus, it's very hard to come down from that plateau. It can go higher, but it's very difficult to get it lower. And therein lies the problem. And I'll just add to the equation this. For whatever reason, the market initially seemed to like that jobs report last week on Friday. I'm not quite sure why, but I'll tell you that the revisions continue downward, and the revisions have been significant. And it's seemingly, Liz, and you can opine on this, maybe it's starting to catch up in terms of the unemployment rate, which went from 3.7% to 3.9. And that's sort of the stair step thing that I've been concerned about that I think maybe we're starting to see now. So 3.7 to 3.9, you start to see this thing trigger 4.1, 4.4 type of thing. Then people will start talking about the labor market. And Larry Summers talked about this over the last couple of weeks, where he thinks there could be a spike in the unemployment rate. I think he backtracked a bit recently, but I still think he's in the camp that, be careful what you wish for in terms of the unemployment rate, because once it starts to move, it's going to be very difficult to stop it. And, if you have inflation, it's still a problem. And if the unemployment rate starts ticking up in the face of that, you got a bit of a dilemma there, Dan Nathan.
Yeah, one of the things, Liz, maybe you can talk about this because you're all into these like rules and stuff. You're a big strategist. I saw Joe Wiesenthal at Bloomberg in his morning note, which is actually a great note. The 5 things, I think. He was talking about the Sahm Rule. So Claudia Sahm was at the Federal Reserve, I don't know, 5 years ago or something like that, and it was talking about a certain percentage of a rise, specifically in the unemployment rate, will likely signal a recession. It's not something we've heard a whole heck of a lot. Joe brings it up this morning. He says we're not there yet, but this is something like David Rosenberg has been talking about from Rosenberg Research for a while. And again, Guy, you made this point again and again. We were kind of stuck at that 3.7% unemployment rate for months and months and months. There was a lot of funky stuff, though, going on. You just mentioned those sorts of revisions and the like here. The quit rate, I think Joe talks about in his note this morning. Liz, talk to us a little bit about that, because Guy mentioned, and you mentioned it a bunch over the last, I want to say, couple months, about the leading indicator of California unemployment and what that has meant in the past, how it's dragged other states up with it, and especially the size of which California's economy is and the like. So is this something that we're going to be paying more attention to as we get into April and what it looks like for March and what the March revisions and the February revisions look like in the unemployment rate?
Okay, so I'm going to start with why I think the market liked the report on Friday. And if we're thinking about the fact that the market is still obsessed with the Fed, what the Fed is going to do, even though we've pushed cuts back, I think what we interpreted some of Friday's report as, and the JOLTS report that happened a few days before that, add those two together. And I think the market still saw, okay, the Fed will cut rates this year. We'll get some of this relief the Fed put is in play. The fact that the unemployment rate stayed below 4, I think, is the only thing that's important, that was important on Friday. I think that there's probably a mental threshold at 4% that will give people jitters, even though 4% is, frankly, quite a healthy unemployment rate. There's what's called frictional unemployment that's always present. Even in the healthiest of economies, you usually have an unemployment rate that's somewhere around that 4% range, just by the simple nature that people are changing jobs, which is why it's called frictional. So there's always going to be a little bit there. I would say anything under 4.5% is considered healthy by historical standards. So however, I do think that the fact that we've been so used to sub 4% unemployment and the fact that it stayed sub 4% is okay. The other thing that I think is going on here, which is not quite as scientific, I'm going to pull up the numbers a little bit. We've had a lot of fake outs. And I'd almost say that this is more like the kid who cried wolf. So if you remember, the unemployment rate ticked up at the end of 2023. So this is August through October of 2023. We went up to 3.8%. We jumped from 3.5 to 3.8. And that's when some of those warning signs went off. That's when we started talking about the Sahm Rule, because if we had gone from 3.8 to 4, the Sahm Rule would have triggered. But what happened was we went back down to 3.7 and everybody said, see, everything's fine. So I think we've had a lot of fake outs. We've had a lot of fake outs in the market where we've had some little pullbacks, but they never got that concerning. We've had little upticks in continuing jobless claims, but they never got that concerning. And I think that's where people are expecting this to go. So 3.9% is the highest that we've been in this cycle since unemployment has gone really low, but we're still not convinced that it's going to go much higher. The leading indicators, point to your point, Dan, one of the things that is important to watch, and I did tweet this last week, Mario was great about figuring this out, putting this together, is when you look at the JOLTS report, of course, we know about the headline number, which is the job openings. We're watching that very closely. Everybody hears that one. But under the surface of that same report is something called the quits rate. And the quits rate goes down usually when people are more worried about what would happen if they did voluntarily quit their job. So if they're less confident about finding a new job, there are all kinds of measures that do this. There are other surveys that ask people, do you think jobs are plentiful? Do you think jobs are hard to get? All of that stuff matters. Here's what matters in the quits rate. It went down again this month, and it is now below, I believe, pre-pandemic E, but still close enough. In any event, it went down, and generally the relationship between the quits rate and wage growth is a 9-month lag. So if the quits rate is falling, that means wage growth likely follows about 9 months later, which means we could expect wage growth to keep going down. So you put some of this together, we've still got an unemployment rate that's low. People are okay with that. We've got the expectation of wage growth going down. People are okay with that because it means the Fed will still cut rates. And we've got these revisions in the rearview mirror that continue to go down about jobs added, which means, okay, the Fed will still cut rates. This is where the rub is. And all of those statements, frankly, are probably true, right? The Fed can be more comfortable that the labor market isn't as tight. But the rub here, and Guy, you and I talk about this all the time, is that are those good reasons, though? Those aren't good reasons to cut rates. The labor market is weakening. More people are unemployed. We've got the big states with unemployment rates rising. We've got people quitting less. We've got job openings going down. Those aren't good reasons. I think we just haven't crossed over the threshold of scary yet.
You haven't got past that Rubicon. By the way, my favorite psalm, Dan, is Psalm 23. The Lord is my shepherd. He leads me in the path of righteousness. So I just wanted to throw that out there so I would be on this ledger as well. But to your point, that's not good reasons, right? And if you think about what's been happening with the U.S. consumer, of course they've been spending without question, but they've been spending because they've been fighting inflation with debt, with credit. And that's a problem. And it's manifesting itself in some of these credit card debt numbers, which is, again, credit card debt in the United States now north of $1.15 trillion at an average interest rate, I think, north of 24% or so, which is a staggering number. And then if you look at total consumer debt, you're north of $17.5 trillion. So, we look at the U.S. consumers want to spend. Now they're wanting to spend because they have no choice. That's how they're sort of dealing with the inflation dragon that's still a problem for, I would say, the majority of people in this country.
Yeah. Well, mine is Ezekiel 25:17. The path of the righteous man is beset on all sides by the inequities of the selfish and the tyranny of evil men.
That's not a psalm, but okay.
You know what I'm doing there, though? That was Jules from
it was Jules. Sam Jackson.
Yes, there we go. Okay. Let's move to the evil reversal that we saw in Friday's trade. So we are recording this right before the opening on Monday morning. We started out last week highlighting some of the data that we were focused on, but we also highlighted Broadcom's earnings. And we kind of made the kind of comparison to the focus from a couple weeks earlier when NVIDIA was reporting. And again, that was a really important one, I think, for many, many reasons. I think, Guy, you and I both sat there on the desk of Fast Money. That was, I think, February 21st. Okay, when they reported, we looked at the beat. We looked at the raise. We said, fantastic. Everything's going great. Everything they said on the conference call was fine, but the magnitude of the beat and raise of 10%, we were like, it doesn't really justify the stock, moving the way it did to the upside. I think it closed up, 5, 6, 7% the next day or something like that. So then we wanted to kind of refocus here on Broadcom. Okay, this is a stock that we made the point, much cheaper than many of its semi-peers. It's starting to really kick in as far as the focus on what they will be getting from generative AI and the like here. But on Friday, hours after their earnings and guidance, the stock was down almost immediately, right? And never really saw too many upticks, closed down 7%. Marvel, another name in the space, closed down 11.5%. At one point in the morning, it didn't matter. NVIDIA was absolutely raging Friday morning. It was making new all-time highs as it's done, for the last, few weeks or so. But then it reversed and closed down 10%. The SOX and the SMH, the ETF that tracked it, closed down nearly 4%. So let's see what sort of follow through we get to the downside. But Guy, my question to you, and here's another thing. I don't know if you guys are paying attention to this. I guess there are some trading platforms like Robinhood and a few others that are doing 24-hour trading of a certain name. So you can trade them all weekend long. And I saw a report somewhere that, on very low volume, but these stocks are kind of moving around. The bid ask is really wide. I'm sure it's expensive to trade. It seems absolutely insane to do so on a Saturday or Sunday when you can't see anything else that's going on anywhere else in the market. But I saw something maybe on Twitter last night or something that the stock had a $200 billion market cap move on very low volume. Now think about that. You can manipulate something, you know what I mean, in a low volume environment like that when no one else is paying attention, this and that, or whatever, and create certain narratives. So, guys, thoughts here on what we saw out of semis. And listen, my personal view is I suspect we see a little bit of a follow through at some point, and let's see where and how it stops to the downside.
All right, so technically, when you see reversals of the magnitude that we saw on Friday, and specifically about NVIDIA, but you mentioned a number of other different names, NVIDIA did it on what was almost 2.5 times normal volume, number one. So you had a huge volume day, and then a significant reversal. And you mentioned that, and Elizabeth and I and you were talking prior to this show about the magnitude of the move in terms of market cap. And I don't have the number right in front of me. You can Google it or we can put it in the show notes, but there are probably anywhere from 50 to 60 companies in the world-ish that have market caps of about $250 billion, $250 billion or so dollars. That's the move that we saw in NVIDIA over the course of a few hours on Friday. And the point that I made on the show on Friday, and the point that I'll make here is, if you think there's some normalcy in that, there is nothing normal about that when a company of that size has a move of that magnitude, both up and down. So technicians will look at this correctly and say, okay, that's an engulfing pattern. That's a bit of a reversal. You have to pay attention to that. We'll see if there's follow through this week. You can completely discount it. You can say, you know what? NVIDIA and the semis are going to shrug it off. That's fine. That's your choice to do so. Or you can say, you know what? This is a pattern. This is something that I want to watch and see how it plays out. Because historically, regardless of the sector, this is a powerful indicator, both to the upside and the downside. You see engulfing patterns when stocks make lows and then reverse higher. Well, you saw the same thing on Friday to the downside. So this is an extraordinarily important week, I think, to see if there's follow through to the downside, which, by the way, I'll go out and say it. I believe there will be. Now, if I'm wrong, believe me, I'm the first to say that I was wrong. But that's a pattern, and that's the amount of volume that you can't sort of ignore, Dan.
Yeah. So when you look at just market action, I'm trying to pull up a couple different tickers here just to see what really happened with some other stuff on Friday. So let's start with the fact that I think everybody can agree that we all thought NVIDIA needed to give a little back, right? It had been a meteoric run. We've put that chart up multiple times on Market Call. We've talked about, everybody has seen that chart. And whether it's something that's driven by fundamentals, which part of it was, right? Part of it has been driven by fundamentals. They've had great earnings reports. They've been at the forefront of this AI theme. I totally get that. I'm not saying that the stock traded on thin air, but the move that it made was so large, so big in magnitude that it started to make everybody nervous. I think even the bullest of bulls in NVIDIA. So giving a little bit back, maybe not so surprising. I think the more interesting part is how the rest of the tech sector acted, because something that I had been talking about last week on CNBC and in a couple other events, probably here, is that where is the money going to go, right? I think we all started to get comfortable that the money was probably going to keep coming out of some of the Magnificent Seven, some of those big names that had run, NVIDIA being one of them, just because of valuations. But where was it going to go? I didn't think it would go entirely out of equities because risk appetite is still alive and well. it would probably rotate, and it already had started to rotate into some of the more boring tech names, some of the more old school tech names, or even down the market cap spectrum, or into things like small cap biotech, right? Some places where people could find growth, but that weren't so obviously overvalued. So that trend may continue. A little bit of that happened even intraday on Friday.
Yeah, and another name I think it's really important to focus on. We spent a lot of time obviously talking about the semis because of NVIDIA. And again, in the last 2 months, gained $1 trillion in market cap, to Guy's point about things that we've never seen before that you might think are wildly bullish because it's being expressed in the markets in a euphoric manner. We'll take the other side of that. We'll say that it's actually very dangerous. And, when we just talked about the amount of companies in the S&P 500 that have a $230 billion market cap. So for one company that has quickly become the third largest equity in the U.S. to move that way, and you think about the knock-on effects, Apple was the recipient of the sell-off in semis and was the opposite. Guy, you'd made this point numerous occasions over the last month or so as Apple had been underperforming, that people were taking money out of Apple because of their lack of Gen AI strategy and putting it in the things that were working. Another name that I think is really important, though, this week, Adobe is going to report Thursday after the close. This is a $250 billion market cap company. All right, think about that. So on Friday, NVIDIA moved the size of Adobe. Adobe had been a company that a lot of folks thought, they'd been, spending tons on R&D and machine learning and moving towards AI. Last month, they introduced a bunch of AI, a chatbot, a bunch of assistants, for a lot of their products. This is an 89% gross margin company. They're expected this fiscal year to have 11 or 12% earnings and sales growth, trades at about 31 times. You could say, okay, that the stock is basically not really outperformed by any means the S&P or the NASDAQ. It's down about 12, 13% from its recent all-time highs. You could say this is like a great name to play in the space. Not that expensive relative to that growth and the like here. But I guess my only point is that 2 consecutive quarters, this stock has sold off based on what they've told you about the prior quarter and the quarter that they're in, that they've guided to. And I just don't think in this environment, they're going to be able to put up a beat and raise that justifies maybe the valuation and maybe the way that sentiment is turning, Guy, a little bit in this space. So to me, this is the name that I want to focus on this week, because a disappointment here might take I guess the bloom off the rose of some of these other software names that have been hanging around the rim here.
It's interesting. I think Adobe topped out right around $700, and like many stocks, by the way, in November of 2021, like many stocks in the form of November of 2021. It obviously got more than cut in half, like many stocks did, and it's rallied back. But you know what, to your point, the rally back has been significant, but it got us nowhere near that prior all-time high. As we're sitting here today, Adobe's probably trading either side of $550. Again, not playing stock market necessarily, but the underperformance here is interesting when you compare it to some of the names that we spent the last few minutes talking about. So, yeah, I think you can look at this stock, just given its size, not as necessarily a bellwether, but clearly an indication of people's tolerance for risk after they report later this week.
Yeah, here's one thing I wanted to hit really quickly, guys, because this happened on CNBC this morning. Former President Trump was on Squawks with Melissa Lee, Joe Kernan, Andrew Ross Sorkin, and Jay Clayton, who is a former head of the SEC, and they covered a lot of topics. Let's just focus on the ones about trade. It was kind of interesting, Guy. No, you didn't. Liz, you saw it. Guy, you did not see it. It was pretty interesting. It was actually like they asked him anything. You know what I mean? They even asked him about crypto, which I thought was kind of interesting. But his stuff on trade doesn't really mesh anymore. You know what I mean? I think what we would expect, though, and this is the sort of stuff that, we've talked about the election and how markets will perceive it. And, as we get closer to it, and it's probably months and months away. But I think, make no mistake about it, a second Trump term will be far more protectionist. All that being said, the Biden administration has not taken their foot off the pedal as far as a lot of the trade, restrictions and tariffs and a lot of the rhetoric with China. So it seems like this is going to be, bipartisan one way or another. But I think that, Trump is probably going to try to outdo the Biden administration on the course of this trail over the next, 6 months or whatever you want to call it. And so I just think that's something to kind of pay attention to. And Trump said something, Guy, really interesting. He said, well, tariffs stop wars, meaning like if countries don't want tariffs on their products. You know what I mean? They don't want sort of agitation. That's actually not true if you look back on the history, right? Guys, speak to that really quick, and then I'd love to get.
I mean,
yeah.
Why do you think? I go back to 1941. Go back to 1941. The reason why, the think about what started the war in the Pacific with the Japanese. I mean, I understand it was Pearl Harbor, but what do you think was sort of the precursor of Pearl Harbor? Was sort of oil embargoes and stuff with the Japanese. So, listen, I don't want to play history lessons here. You can look at however you want. The reality is, if you infuriate an opponent, if you back him or her into a corner, typically bad things happen. And I think to the point about protectionist, it's inflationary. I mean, there's no other way to look at it. I mean, that's just the reality of the situation. And you can say, you know what, former President Trump was right to take on the Chinese. Yeah, probably. I mean, the Chinese have probably been ripping us off since the Nixon administration. I mean, that's a bed that we wanted to lay in way back in the day, and there's a price to pay for that. And maybe he was right to take them on. It's the manner with which he took them on that I think some people have problems with. But to your point, Dan, the Biden administration in some ways has sort of continued on that same path. You're basically, we're painting the Chinese into a bit of a corner at a time when they're probably the weakest they've been in decades. In my opinion, and this has been something I've been saying for a while, I don't think that ends particularly well.
The only thing that I would add to this, and I'm sure other people have other opinions on it, is that because the Biden administration, to your point, Guy, and to your point, Dan, has continued with some of this same effort, the first Trump term, at that point, at least it's my feeling or my sense that there was a lot more bifurcation among that side of the aisle and the Democratic side of the aisle about the fact that we were going to go after trade so violently, right? With tariffs, we were going to be so focused on trade. Now, it's not as much of an opposition. I don't think it's going to be this huge difference in the campaigns, whereas before that was the big difference. There was tax reform, there were tariffs that were put on, and he followed through on a lot of that. But this time it's not going to be, I don't think it's going to be the big hot topic.
Yeah, I thought it was interesting, though, also, I think many listeners probably know my view on the former president, but, he basically flip-flopped on this whole TikTok thing. This was a question that he got from Andrew Ross Sorkin. It was something that was in, the press last week. I mean, he went on to say on this interview this morning that, yes, he did try to get TikTok banned, but now, for instance, he's on TikTok and thinks it's great, which is kind of interesting. So, again, we need to have, obviously, a very coherent policy towards China. And I think a lot of what the Biden administration has done with advanced chip sales, I think is notable, especially at a time when they're incentivizing U.S. chip manufacturers, you know what I mean, to build here. Taiwan Semi had a week last week until it reversed because they're also going to be benefiting from getting billions of dollars in the CHIP Act to build here. So that theme is something that came about during the pandemic too, right? Reshoring as a measure of national security. Guy, you've talked about that a lot. I just feel like I bring this up because I think it's a topic we're going to be spending a lot more time on as we get closer to the election, because both of these candidates are going to be going back and forth, speaking to their own records over the last, call it 7 or 8 years, and then what it looks like. And we spent some time on this last Monday. What's going on in China, to Guy's point, it's about as weak as they've been in our lifetimes from an economic standpoint. And so at some point, it would probably make sense to kind of find the things that we can agree on and work together on, because, their population and some of the demographic situations are going over there. You made this point, Guy, again and again. They're thinking 50 years out. We're trying to figure out how to solve to the next presidential election cycle here.
It's very different. Not that I'm a student of Sun Tzu, The Art of War, but you have to know who your opponent is, and when your opponent's willing to lose battles in order to win wars, and when their time frame is decades, not minutes, that's a very difficult adversary to combat and to defeat. And by the way, the fact that I was able to pull 1940 oil embargo out of my what was pretty remarkable.
Out of your perplexity machine. I'm just kidding, Guy. All right, listen, guys, here's the last thing I'm going to leave you this.
My you really think, by the way,
I'm kidding.
And this is,
oh, no.
We had the Perplexity CEO on the OK Computer.
Yes.
Not we, you did, which was great. And over the weekend, what's that publication with the little dots that used for pictures?
The steeple pictures, the Wall Street Journal.
Yeah, they had a little article about
That
that.
little that little publication. I will say this. This is a little history lesson of the Dan Nathan history, if you guys care. And a week from today will be my 24th wedding anniversary, and I can always remember the number of my anniversary because I was born, or because I got married in the year 2000, right? So that makes it kind of easy for me. But this day, I think it was probably March 11th or something like that. I closed down my trading book. I was at a long short equity hedge fund, and I was pissed because the markets were getting kind of spicy. You know what I mean? There was lots of cross currents. There were, some euphoric action going on in some of the internet stocks and some of the stocks that were kind of, centered in and around them. And then, the S&P had already started to roll over a little bit. They were calling them old economy names, Liz. I swear to God, they called them old economy names. You remember that guy? And I was like, for the sort of trading that my fund was doing, this was like a great environment. So I was really disappointed to be leaving. And then I literally went away. I got married. I went away on a honeymoon for a couple of weeks. And I came back, and the market, the bull market was over. I'm just telling you, like, I knew it. I obviously was bearish back then. I knew it, but I missed a few great trading weeks. I can't tell you guys, I really do believe that what I'm feeling right now feels not too different than 24 years ago. Not about all my excitement about going off and getting married and all that sort of stuff, about what's going on in the markets. It just really feels like we're at an inflection point, Liz. Like, take us out with some of your, like, a little bit of a vibe check here as far as the market is concerned.
Well, first of all, congratulations to you and Sarah. I'm sure that you are equally as blissful today as you were 24 years ago. So here's the weird thing about markets. And again, I'm not a huge subscriber to seasonality, but the weird thing about markets is that weird stuff happens in March. And you've got the other piece, Guy will like this one. I think it's a Shakespeare thing, the Ides of March coming up on Friday, which is usually an ominous signal. But weird stuff does happen in March. And this is the other piece of the narrative that has shifted. Remember back a year, 2 years ago, maybe, we were like, can the market survive without Apple? If Apple doesn't go up, the market can't go up. We just moved that to, can the market survive without NVIDIA? And now we've had a couple days in NVIDIA that don't look great. People are getting a little nervous. We're going to find out, I think, very soon whether or not the market can survive without NVIDIA.
It was the soothsayer, by the way, you can look that up, that said, beware the Ides of March of obviously Julius Caesar. And we try to be soothsayers here, which is a difficult thing to do. Obviously, it's easy to talk about things in the rearview mirror. We're obviously trying to look forward and figure out what's going to happen. But the final line, obviously, by Julius Caesar was a tu brute, then fall Caesar, not die Caesar. A lot of people make that mistake. I don't. A tu brute, then fall Caesar. Back to you, Dan.
Yeah, sorry about not nailing that psalm. I don't know the Bible, yours or mine, particularly well, but I love at the end of that speech, he goes, and I'm trying to be the shepherd here. You know what I mean? So that's what we're trying to do. We're trying to shepherd you guys through this, have a little fun while doing it. Have a great trading week. You know where to catch us. Market Call, Risk Reversal Media YouTube page. That is Monday through Thursday, 1 p.m. Check it out, people. Liz is at Liz Young Strat on all of the socials here.